Chapter 5 of personal finance deals with making decisions to either lease or buy an automobile or rent or buy a house. So these are things that you're going to have to consider, or maybe you actually have already considered. But you want to obviously choose the best car for you. There's a lot of different alternatives. It depends on what your needs are. If you have family needs, if you do a lot of traveling, are you really worried about it being fuel efficient? Do you need to tow something? So I mean, those are things that you need to consider. What are my personal needs and what type of vehicles are out there? Then do a little bit of research to look at prices. A lot of times you can get a vehicle that maybe is only a year old and it's going to be quite a bit less than buying a new car. But then sometimes the manufacturers will give rebates and give low interest loans if you do buy them new. So you got to consider both those things. Okay, if I'm going to buy the used one or the kind of nearly new one, how much money am I saving? And then compare that to what the rebates that are out there, because sometimes it's better to just go ahead and buy that new one. And then also research your different prices, because a lot of times if you go to the dealers, they may have ones that are loaded with all kinds of extras that you don't really need, and you could maybe save thousands of dollars if you just pick the extras that you want, that are very important to you and you're willing to pay for. So do a lot of research on that. Then you also have to consider if you're going to trade in your car. And then you have to know a little bit how these dealerships work. A lot of times what they will do when you're dealing with a salesperson is if you do have a trade-in, it's just another way for them to get the price that they want you to pay. And they'll say, okay, well, I see your trade, but there's this and that wrong with it. I'm not going to give you the blue book. I'm going to give you this lower amount. And then you have to decide, okay, am I willing to take that, or should I try to sell it on my own? It all depends on how much effort you want to put into it. It's definitely easier to just trade it in, but do the research so you know what that Kelley Blue Book is and what is a fair trade-in, and maybe go to 3 different dealers and see what they're going to do. Then also the other thing that dealer or the salespeople try to do is say, well, how much do you want to pay each month for that car? Well, I never tell them that, because if you tell them that, then they will just work out like a loan, because anymore you could have a 4-year loan, a 5-year loan, a 6-year loan. You know what I mean? They've just taken it longer and longer. So maybe you're thinking, well, I'm okay paying $350 for 4 years. Well, then they'll say, oh yeah, we'll give you the $350, but it's going to be a 6-year loan. And then you're like, wait a minute, I don't want to pay for those extra 2 years. So I normally try to not give them that information. They do really try to push you for it. I mean, you should know in your mind how much you're willing to pay, but you really want to get them to give you a price for the car. So do your research ahead of time and kind of know what you think would be a fair price for the car is, what you think a fair price for the trade is. And then the other thing I've had dealers do, and I don't know if they've stopped this, if you are going to trade in your car, they're going to take your keys, and then they don't give them back. They go give them to the manager, and then you're kind of stuck there talking to him. So I never let them do that. I always say, you can look at my car, but I want my keys back immediately, because then I can leave. If I feel like it's too high pressure or I don't like where the salesman's going, I can just take my keys and get out of there. So just be careful, kind of know some of those things. And then also, the other thing I recommend is doing some research into your financing options, because if you know ahead of time, like, so again, I said last time I bank at PNC, but PNC gives some really good auto loans, and you can contact them and say, you can do a pre-approval to say, okay, I'm looking at a car like up to $20,000, and then you can get pre-approved, and they send you the check that's valid up to $20,000, but then the dealer's going to fill in the amount, and then again, you've taken a little bit of that power away from the dealer, and now you have it. Now, sometimes there's good deals though. Sometimes the companies themselves, like if you're going through General Motors or Ford, they may give you like 0% financing. So you don't want to not take those, but definitely just do some research. Don't ever walk into a car dealership blind and then hope that you're going to get a good deal or hope that you're going to get a good rate, because it doesn't ever work that way. And they kind of push you into stuff that maybe you're not completely sold on. You could also consider leasing a car, and that I think is your personal preference. If you're the type of person who thinks in 2 or 3 years I'm going to be done with this car and I'm going to be ready for the new model or ready for something else, or maybe there's this phase in your life that you know, okay, after 2 years I'm going to be out of college and I'm going to have a better job and I'm going to want a different car, then leasing is probably right for you. Sometimes you can get some really low prices on a lease, but you just have to be careful when you go to trade it in. You don't want to be over on your mileage. You don't want to have any damages, because then they're going to make you pay, or they're going to say, well, let's just go ahead and you buy the car from us and then you don't have to pay us these fees. And then and then it's not necessarily always a good deal. So you got to be the right person to lease. I've never leased. I've always purchased my cars. But I'm also not a person that feels like I need a new car every 3 years. I keep my cars for probably at least 6 years, maybe 7 years, as long as they're still in good shape and that type of thing. So again, you just have to look at your needs to see what type of a person you are. Then housing is another big purchase and another big loan that you're going to have to get. And then you need to consider the different options. I mean, you could just, depends on the size of the house, depends on the neighborhood you're looking in, but maybe, or your age, you could consider a condominium. Normally your condominiums are cheaper to purchase, but then you have monthly dues that you have to pay. But included in those monthly dues, a lot of times are your maintenance costs. So they're going to come and plow your drive. They're going to come and mow your lawn. If something happens to your roof, they're going to come out and check it out. So that's a nice way to not, if you're thinking, well, I don't have the time or the ability to keep up with those things. A condominium could be nice. You could also consider buying a duplex, or maybe you could rent out half of it. You live in the other half. That helps you to pay your mortgage. And that's also a smart way for people to go if you think you can handle having a tenant. But if you're thinking, well, I'm just looking at a single family home and I don't know, should I buy or should I rent? Again, you want to think about all the costs that are included in buying. You have to pay your homeowner's insurance, you have to pay property taxes, you have to finance it. And again, then that's a whole nother thing you got to research to get into, okay, what type of mortgage should I get? You also have to pay, obviously, if there's anything that goes wrong. So if there's your roof gets a leak in it, your air conditioner breaks, your refrigerator dies. Those are all things that you have to be prepared for. Or if you want to, upgrade your windows or things like that, all those things are going to cost money. Where if you rented, that would not be your responsibility to pay. That would be your landlord's. But if you decide, okay, well, I'm pretty sure I'm going to buy, because it's the American dream, right, to own our own homes. So we all kind of want to do that. So then you definitely, though, want to research your different mortgage options. My advice is to always, you want to make sure you have a nice down payment, but then you want to make sure that down payment doesn't completely wipe out your savings, because again, think back to our last chapter, you need that savings, to have a cushion just in case you can't pay your bills. And you need to be able to withdraw from those, or you have an emergency expense that comes up. So always look at how much money you have saved, how much you can put down, and then still have a little bit in your savings account. And then consider how much you're able to pay and factor in the insurance and the property taxes, because a lot of times property taxes can be very high. Again, it depends on the neighborhood you're looking in, but you have to pay those monthly. They'll go into an escrow account. So you definitely have to make sure you're accounting for that when you're looking at the price of the house that you can afford. And don't always listen to the real estate agent. They're not as bad as the car salesman, but they'll still say, oh, no, I think you could afford a house that maybe is out of your budget. Maybe when you're really doing it logically, you think, I can't afford that house. I don't even look through them, because it's just gonna hook you, and then before you know it, you'll be trapped in a mortgage that you really can't afford. So be realistic, know what you can afford, and then just stick to houses at that price range as you're looking through them. But then when you get to picking that mortgage, again, like I said, definitely get pre-qualified. Then that way you know for sure you can get it. And then my advice is to get a fixed rate, because there's variable rates, and they do these different like arms where maybe for the first 5 years all you pay is interest, and then after the 5 years you're going to kick into your regular mortgage where you're paying principal and interest. And then a lot of people get real used to just paying that interest only, and then they really can't afford it when the principal kicks in. So I never think those are smart. I always think go with a fixed rate where you know this is my monthly payment. It might go up based on your property taxes or your insurance, but the loan amount's always going to stay the same, so it won't fluctuate too much from year to year. So that's always my advice, because then you know what you're getting into, you know it's not going to change too much, and if you can, you know, if you're getting that into your monthly budget and you're good, then you're fine. And there's enough banks out there that give you those fixed rate mortgages, so you just have to market around and make sure you're picking the best one. The other thing to be aware of is that they will charge you what is called PMI, or private mortgage insurance, if you don't have a large enough down payment. And sometimes that private mortgage insurance payment is a decent amount of money each month. And then that's just money wasted. It's just money paying for an insurance plan that protects the bank in case you default. So you would be, in my opinion, you'd be better off taking a little more time, saving up a larger deposit so you don't have to pay that private mortgage insurance. Or if you do, make sure that it can be removed when your balance gets down to a certain level, or it's removed after a certain period of time, because sometimes they'll hook it onto the mortgage where you might be paying for 10 years, and that's ridiculous. So just make sure you're aware of all those terms. And then once you're in that mortgage, then sometimes interest rates change and you may consider refinancing. But the only way really you would do that is if the rates drop, pretty considerably. If they're not super low, you would have to pay all those closing costs again and go through the whole closing process. It might not make it worth it to ever refinance unless the rates are 2% lower than what you've already are paying. But so those are both big decisions, and those also you can use our time value money keys. Those are good problems that we can go back to the financial calculator, put in how much we're going to borrow, figure out what our monthly payments are. So there will be some problems that will go right along with those in mortgages and auto loans.